All right, welcome back to the Money Puzzle here at Family Wealth Planning Partners. I'm Chris Vaughn, along with Eric Douglas once again. Right now, it's beginning of August 2022. The last time we did a market update was right after the end of Q2, and it was doom and gloom.
About as bad as it could be. Yeah.
It was not a fun conversation. In fact, I think we converted that conversation into a recording of the Bourbon podcast because
we earned the bourbon, after the first half of the year for sure.
So we were talking about this and we said, you know what, July changed some things a little bit. So we thought maybe it would be a good time to get back with everybody and say, okay, let us kind of talk you through what's going on in the markets right now. Eric, you want to go ahead and get started?
Yeah, well, I mean, I think what's been interesting about July is I think that the whole theme of this show is really what sparked this conversation anyway internally was making rash decisions.
Yeah.
Right? And we always talk about wanting to avoid making rash decisions or emotional decisions in times of volatility. And as we sit here, and now that we're 1 month through the third quarter, we're through July, right? 1 month after things have pretty much been at their low point. I don't want to say the bottom of the market, but it's looking it's looking similar to what hopefully was the floor at the kind of the end of the second quarter. But, the S&P 500 in the month of July was up over 9%.
Yeah.
And so we talk about the most emotional decisions usually occur at highs or lows in the market. And what we pressed so many of our clients, and actually most of our clients have been excellent this year.
Yeah, they have.
But you never want to make emotional decisions when you're at a high point or a low point. Everything, you always want to make logical decisions. And if you had made a decision at the low point at the end of the second quarter, or really through the first half of the year, you would have missed the upside capture that July brought. We've had a really good month in the markets over the last month.
So let me, first of all, I want to clarify something. When you say the market was up over 9% in July.
That's just one index.
That's not an annualized rate. That's an actual 9% uptick.
That's the return
in 1 month.
That's the return of the S&P 500,
that's S&P 500,
which is one index, but the NASDAQ is actually up more than that.
Yeah.
I don't have the number off the top of my head. I want to say that number was up over 12, 13%. Of course, the NASDAQ was down much more. It was down a lot more, so it has a lot more room to come up. And the NASDAQ is typically more growth and tech heavy, so you're going to see.
So it does have more volatile swings.
You're going to see more of those swings, and then the swings are really bad on the downside, but they're really fun on the upside. They've been really fun the last few years, obviously. But where we sit right now is through the month of July, we had a good month.
Yeah.
Knock on wood. I don't want to jinx it. Don't want to ruin it for the rest of the year. But we were talking about we did. Podcast earlier this year. This was even before the end of Q2, where we were talking about numbers in a recession and what the economy looks like, and we talked about how poorly the market performs through really the beginning of a recession, and then the second half. No, we were talking about when the market was down like over 15%.
Right. It was about the beginning of July. We recorded that. I was going to mention that, and we said that the first 6 months of this year was the worst first 6 months of a calendar year since 1940, which is just an amazing statistic when you think about it. But then you pulled some stats that showed, and if I'm getting this wrong, correct me, it was like the worst 10 first 6 months.
Yeah.
Man, that's hard to say.
Yeah.
The worst 10 first 6 months in the last, I think it was 100 years. And in every single one of those, the second half of the year was epically good. Now, none of them completely got us all the way back. Right, but we recovered most of it. Right,
demonstrably better than the first half of the year. I think there was only one instance where it was still positive, but it wasn't like it was negligible how much of an effect. It was basically flat. But for the most part, you saw a recovery through the second half of the year when you had epically bad first halves of the year. We had an epically bad first half of the year, absolutely. And I'm not saying by any means, and we'll get into some other things to look at right now through the rest of the year, because there's definitely still issues and concerns that I have. I still don't fully trust this market and this economy. That's another story, and we'll talk about that shortly. But there are some reasons to be somewhat positive about what's happening right now. And you have to find good. I mean, everyone wants to focus on the bad. That's where all the headlines are. But there is good happening right now.
We've done podcasts about that, too.
Exactly. Yeah, about the negative headlines.
Yep.
Yeah, absolutely. There's always negative headlines. If it bleeds, it leads. It's no different in the financial news media than it is on your local news, We need to look at some of the good stats, though, some of the good things. And you've got some inflation numbers. We'll talk about that. But I was just digesting some data this morning. Have you looked at shipping rates lately?
No, I have not.
So supply chain, that's been a huge issue over the last year, even before really we started getting into record high inflation. It's always been an issue through this COVID, through the last couple of years. Shipping rates are way, way down right now.
Really?
So if you're shipping goods overseas, it's a lot cheaper right now to ship goods than it was 6 months ago, than it was a year ago. We're back down to basically what the levels were pre-pandemic, which is fantastic news for supply chain issues.
Which is interesting in the wake of the inflation in energy costs, specifically fuel.
Yep. Well, fuel jumped way up.
Yep.
That's come back down. So if you've looked at your gas prices over the last month, we talked about the bump in the stock market. Well, guess what's that coincided with?
Yep.
It's coincided with a drop in energy, namely gasoline, of course. Yep. So we're getting some much needed relief at the gas pump over the last 30 days.
Right.
Once
Still
again,
not good.
Knock on wood. I'm gonna do a lot of knocking on wood today, but because I don't want to jinx any of this, right? But we're paying less at the gas pump.
Yep.
So when energy prices start coming down, you're seeing shipping rates coming down. That's a really good combination for making sure that the supply chain is back up and running, and inventory issues aren't a concern for most retailers. Retail sales GDP growth was negative in the first 2 quarters, and we talked about how that's obviously one of the biggest indicators of a recession. Does not automatically mean we're in a recession. We did an episode about that as well.
We did a podcast on that too, yeah.
So commonly, we're
the most common definition of a recession, we are there. And that is 2 consecutive quarters of negative GDP growth. That's the most widely accepted definition, but as you pointed out, there is no exact definition.
Yeah.
It's just not there.
And when you look at some of the other indicators that they use to determine what a recession or when we are actually in a recession, those other indicators are still positive. That might change over the next year. So, once again.
And something I want to point out, the whole word recession, that one's been flying around for 6-9 months now. And it's doom and gloom, and it's, oh my gosh, the world is coming to an end. It's Chicken Little with the sky falling. Recession in of itself is not necessarily a bad thing. To me, it means, okay, we finally got that one off the table. Now we can get back to work and put this thing back together.
Now we can recover.
Exactly. Now we can recover instead of constantly going, oh, we don't want to make this one little mistake that'll trigger a recession. No, we're there. Now let's get back to work.
Yeah.
Let's fix it.
And we always look, and we talked about this. This is a stat that I saw recently, but you talk about, 68% of the time when a recession is announced, we're already recovering from the recession.
You're already out of it by the time the news is coming out.
Which basically means the stock market is the number one indicator or leading indicator of what the economy is going to, what's going to happen with the economy. Well, we had a really good month in the month of July. We're seeing some other leading indicators. So stock market's the ultimate leading indicator. Sure. But, we're seeing other leading indicators. Like I said, some of the ones I just mentioned. But inflation is obviously the big one.
Oh, yeah.
And you've got a whole sheet in front of you with some stats
great
on
inflation numbers, yeah. Okay, so when we were talking about inflation, we were talking about how bad it was. The last number that we had was the June number that came out. So it's about a month old now.
Yeah.
That was 9.1% inflation since June of last year.
Year over year.
Mm-hmm. Doom and gloom. Okay. But, I pulled some stats that go all the way back to 1961. So year by year, decade by decade. I've even got 20, 30, and 40-year periods here as they apply to see what inflation is typically like. So, for example, when you think back to the 1970s, that's the one that I've heard a lot on the news recently, and this is the worst since the 70s. Okay. 1973, 7.4%. 1974, 11.9%. Remember, you had an energy crisis back then, too. Right? That's the first time, if I remember correctly, when people were going into gas lines.
Oh, yeah.
Just to get gas. I was 3. I don't remember it that well, at all.
I was non-existent.
Yeah, but the year after that, 75, 7.9, then 5.5, then 6.6, 8.3. So you're getting back into those numbers that right now feel brutal. But check this one out. 1979, 12.2. Mm-hmm. Compared to where we are now, 12.2 sounds like a true nightmare. Oh, by the way, the next year, 12.6 in 1980. 1981, 11.0. So you've got three years there in a row that are considerably worse. If you think about it, to me, 12%, That's a full third worse than 9%, right? That's a true, nightmare scenario. But why were those there? Okay, in my opinion, and I know Eric and I totally agree on this one, that was just bad economic policy. A lot of things happened that were not necessarily somebody's fault, bad economic policy, and it causes that. So what did you do immediately after that, right? Go into the 1980s. 1982, 5%. 83, 2.9, 4.3, 3.1, 1.8 in 1986. What did you have going on during that time? Good fiscal economic policy. So you can't separate what's going on now from the politics. We want to, but you can't. But you look at this and it goes on, you made a great point when we were talking about this earlier. Those numbers are all still higher than what we feel like is normal. So let's look at just like the last 10 years, right? Since 2009, negative 1.3. You actually had deflation that year. That's the only year in the last 60.
And why did we have that in 2009?
Yeah.
08, 09, we had the Great Recession.
Exactly.
Then, right?
So 2010, and I'm just going to go in order starting in 2010. 1.1, 3.9, a little bit higher that year. 2.0, 1.2, 1.7. 2015 was 0. It was flat. 1.5, 2.2, 2.5, and the numbers I've got end in 2018. So the point here is that we have become used to what are, I would argue, artificially low inflation numbers.
I would say ridiculously
low. It's a good one.
Well below average. If the average rate of inflation,
right,
and this is including those recent, the last 10 years, the average rate of inflation is over 3%.
If you look at it over the last 40 years, okay, ending in 2010, the last 40 years, so that's my lifetime, the average inflation per year over that period is 4.4%.
Yeah.
So that's why I think it's artificially, ridiculously is a good word, low inflation, and we get used to that and we start budgeting for that. And that's not, when the inflation does catch up, which it has done, that's when there's some serious pain, and that goes back into the market issues, right?
Well, life is all about expectations.
Yep.
So if we set a new standard of expectation over the last decade, or I say the last decade, it's more than that, since 2009, if we set an expectation that we're not ever going to have inflation higher than 2%, when you start getting into 8, 9%, obviously it's going to feel like a shock. A couple obvious things to consider, and we've talked about this before. We were due.
Yes, we were.
We needed some inflation. Yeah. We were due for inflation.
It's a horrible thing to say, but it's true.
You hate to say it, but we talk about it with recessions. Sometimes you need a recession to,
reset.
You need to reset. You need to separate the wheat from the chaff. We're doing the same thing here with inflation to some degree. It's a natural part of the economic cycle. What's not natural is inflation rates that we've had over the last decade or the last 12 years, really. So we needed some inflation. We're just getting it all at once. I'm not saying that's healthy either.
Right.
And a lot of the inflation that we're getting now, once again, going back to your point in the late 70s, it's bad economic policy. Right. You try not to get too political. Unfortunately,
there's no way around it.
Politics is entwined in literally every aspect of our lives now at this point, most especially with the market, because when you see it all the time. The president goes on TV to speak, and the market goes up or down based on what they say. The Federal Reserve Chairman goes on TV to speak. It goes up. The market goes up or down. There have been
numerous times, if you were to come hang out in our office. In my office, I've got a TV, and I keep the business news running, and Chairman Powell will be on talking about whatever they're going to do with the interest rates. And the longer he talks, we'll see the tickers in the bottom. Yeah. Eric will come in and watch it in my office, and we're yelling at the TV, shut up. Because the longer he talks, the worse it gets. Politics are involved in everything. Mm-hmm. There's just no way around it. And in this particular case, with both the markets and with the inflation rates, you had a catalyst. We were overdue. But you had a catalyst in COVID and all the lockdowns and everything. And there are repercussions to those decisions that were made, and we're paying for that now. We're paying for that in money supply issues, which is why we've got such high inflation. Although I think you and I agree, we probably have peaked out on the inflation rate. Now, that doesn't mean it's going to suddenly drop down to 3 tomorrow. That's not going to happen.
We're evening out a little bit. And we're seeing, once again, so some of the indicators that I just mentioned before. So you're talking about shipping rates coming down, energy prices coming down, other commodity prices falling through the floor. I mean, like aluminum, copper, iron, things like that, right? It's not just energy. That's the one everyone focuses on, but we use a lot of different things to make a lot of different products out there. So all those other different commodity prices have come down really over the last month. So that's another leading indicator.
Yep.
So there are signs out there that suggest we're also seeing record high inventories. Retail spending has gone down. We've had negative GDP growth, so people have slowed down their spending.
Which means the inventories get stocked up.
So you're getting higher inventories.
Yeah.
Okay, well, what happens when companies have higher inventories? Well, they need to get rid of that inventory.
Right. They run sales.
How do you get exactly right? How do you get rid of that inventory? The easiest way to get rid of that inventory is to lower prices. When you have an excess amount of supply, the only way to increase demand is to lower the cost of that supply. It's all basic economics. It's amazing how much of it all comes back to just basic supply and demand. This is everything comes back to that same
Economics 101.
Exactly.
First day in that class, this is what you learn.
You try not to make it any more complicated than that, but that's where we are now. And you and I have talked about this, and obviously with our other partners as well. We still don't really trust.
Yeah, I'm not totally there.
I'm not ready to say we're in a recovery.
Right. It feels like it, but I'm with you.
It's been a good month. I'm going to take what the month has given us, and we'll be happy about it. We're still not totally comfortable for a few different reasons. I think one of the biggest reasons is the Fed is still out there raising rates.
Yep.
They've already announced another rate hike for August, and I think September as well. So we've got at least 2 more coming. So
that's the plan anyway. Yeah.
That's the plan. Now, if that plan changes at all, we could see some serious volatility one way or the other. If they decide to raise rates even more than that, that's not going to be good. If they raise rates less than that, that's going to be a really healthy sign, because the reason they're raising rates so aggressively is to keep inflation in check.
Right, to slow it down.
So it'll be interesting in August what the numbers come out for inflation for the month of July, what those inflation numbers look like. Because if we see a peaking of inflation in the month of June, at that 9.1% number, if we see it come down even to like 8.9, 8.10%, that's big. That's a really good indicator. So if we can see signs of a peak in inflation, and maybe the Fed decides to be a little bit less aggressive on raising rates, we could be looking at a pretty good fourth quarter, which would be fantastic, and which all circles back to the original point that we were making. That's why you don't make rash decisions at market highs or market lows, because now we're in a position where we're looking at a recovery, and you want to make sure at the end of the day that you're enjoying.
You can't take advantage of the recovery if you weren't there when it started.
You want to participate.
Not full advantage anyway.
If you take your money out, you're not going to participate in the recovery.
What I tell people when I've had discussions, clients have said, so what should we be doing in this, in this scenario? And the way that I always look at it is, in order to take best advantage of your investments, you have to be intelligent about your decisions. What you don't want to do is be emotional. And when you get these wild swings in the market, it's an emotional decision. You've got to throw that one out. Why, last week we had a $1.2 billion Mega Millions thing. Why do people go out and buy tickets for that? Because it's emotional. And I did it. I've spent $10 on it. I admit it, just for fun.
Spent 10?
I spent $10 on
Wow.
it, and we had a good laugh about it. And I told Heather McCormick, our insurance agent, that I said, "Hey, you want me to win that because you get to insure my boat." And she said, "Well, I can insure boats." I said, "Yeah, but this one's going to be a really nice boat." The reason why we buy lottery tickets is because of the emotion of what if I won, right? Well, the same thing applies for a lot of people when it comes to investing. The market is spiking through the roof. Oh, I need to go out and buy, right? Because it's an emotional decision. Oh, the market has fallen in the floor. The volatility is horrible. I can't stand it. I got to get out. That's an emotional decision. If you are invested correctly in the first place, these things are coming. There will be spikes in the future, and there will be huge downturns in the future. We just don't know when and how much. If you're positioned correctly, you should be able to take advantage of that.
Well,
at the right time.
Well, here's the analogy. We probably should have led with this, because now that we start talking about lottery winners,
right.
I mean, the analogy is, when's the best time to play the lottery? when it's not $1 billion.
Yes, absolutely.
Because your opportunities or your chances of winning are not one in what was the number
I think it's like 1 in 302 million or something.
It was 1 in 302 million was your chance of winning that Mega Millions jackpot that
Right.
the guy in Illinois won last week. Poor guy, by the way. Did you see how much in taxes he had to pay? It was $1.2 billion.
What was it?
He's only taken home $443 million. Like, why even play? You're going to give 60% of your income, 60%
Well,
of that pot.
Did he take the lump sum? Is that what it was?
Yeah.
Yeah. Okay.
Poor guy's left with only $440 million, but
I hate it when that happens.
it's ridiculous. You have to pay that much in taxes, right? But the point is, though, you're actually more likely to succeed playing the lottery if you play when it's only $100 million versus $1.2 billion.
But nobody knows who you are, and you can hide from it a little bit easier, right?
But you're going to have fewer people playing, right? But so anyway, same thing. It's the same thing with the market. The best time to participate is when fewer people are playing.
Yeah.
When there's a sale, go buy assets on sale.
Right.
And if you bought at the market bottom, which we're kind of hoping it was, kind of at the end of the second quarter, stocks were on sale.
Yep.
And
we said economics 101 a minute ago was supply and demand. Well, investing 101, buy low, sell high, right? And if you're being emotional in your decisions, that doesn't work. And I'm going to take that opportunity to kind of tee up what our next episode is going to be about. We mentioned a minute ago that if your investments are positioned correctly, you're going to take advantage of both the ups and the downs, right? You're not going to feel that pain. Well, how do you determine how to position those investments correctly? Well, in our not very humble opinion on this one, you need to have a good financial plan. Especially people who are already retired or are about to be retired, you need a specific type of financial plan called an income plan or an income strategy. And that's what we're going to do on our next podcast is talk about some of the different types of income strategies. There's no one right answer for everybody. They do have to be customized to the individual. But if you truly want to not have the emotional swings that the markets have done to people recently, you need a good financial plan because that'll dictate what kind of investments you should be in. You want to add to that?
Well, we'll add to it next week's, and I'm already getting, Whitney over there waving her hands, saying that we're, over time. So I won't go on too much longer. But yeah, I mean, at the end of the day, it's all about a plan. As long as you have a plan and you don't dictate from the plan, and at the end of the day, your plan should include market volatility because market volatility is inevitable.
And inflation.
Recessions are a natural economic cycle. We're living through one right now. Hopefully we're starting to recover from one right now, but there's a possibility that we're not. And if we're not, that's okay. As long as your plan is positioned accordingly to adjust, when market conditions like this persist, you're going to be okay. And that's what we'll talk about next week, how we one of the main strategies we use to mitigate, the impact of any type of a recessionary activity that's occurring out there. So with that, probably a good time to wrap up.
Wrap it up.
So thanks for watching. If you have any concerns about yourself or you think our content might benefit any of your friends and family, please feel free to share our content with them or feel free to give us a call. Direct line 502-200-5210. Ask for myself, ask for Chris, ask for Brian, ask for Aaron, ask for any one of us. We would be more than happy to have a chat, schedule you to come on in, sit down, go over your plan, or start to put one together on your behalf. And we can see how well prepared you are for an economic downturn, such as the one that we're living through right now. Hopefully we're getting through and recovering from at this point. So with that being said, thanks for watching. Appreciate it.
The information given herein is taken from sources at IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believe to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.